Welcome to Ransquawk's EU morning briefing for Wednesday, the 3rd of June 2009. So it's just gone through 8:30 now in Europe, and at the moment we're just seeing the European index futures just hitting new session lows. Again, this is in spite of the slight positive gains we saw on Wall Street close yesterday, allied to around a 0.4% gain in the Nikkei overnight. A couple of pieces just to be aware of in terms of a more general theme for the equities in Europe and the UK. Firstly, in regards to green shoots, that's obviously been one of the major themes with this slight improvement we're starting to see in global economic data. The FT's Lex column, though, a closely followed UK opinion piece, they write that the green shoots is already fading from memory, and they are mostly pointing to the fact that caution is very much in order in terms of these early signs that we may be seeing. Furthermore to that, the Lex column also comments on equity markets. They say the enthusiasm that has lifted the markets since the beginning of March could well be doomed from the outset. A couple of things that they point to, they're looking at the cyclical commodities which have surged, which will in turn hit wallets and already battered company margins. And then also the steepening yield curve hitting credit and other further rises in mortgage rates, which will also damage property prices. So somewhat of the gains that we're seeing can be, in effect, self-harming according to the Lex column in the FT today. Just looking elsewhere in terms of some other news just to be aware of that has come out overnight, starting firstly with the US Wall Street Journal commenting further in regards to capital raising. Obviously we saw the likes of Morgan Stanley, JP Morgan and American Express in stock offerings yesterday as we saw the new outline for TARP repayments that they have to raise private equity firstly. In turn then the Journal reporting this morning that US banks and financial firms that underwent those stress tests initially have raised as much as $85 billion, more than the amount regulators required them to get according to unidentified officials in the Journal article. And elsewhere, Fed's Fisher, he spoke overnight, starting to see some results from Fed's efforts to support credit markets, but he did pay note that there's no exact formula as to when to start withdrawing stimulus. And then on the geopolitical fronts, continue from North and South Korea. South Korea now aims to buy more ship-to-air missile interceptors from the US by the end of the year in order to strengthen its defences against North Korea. That's the latest out of Yonhap news agency. And in the FX markets, we've seen some fairly notable moves, quite volatile as well. The dollar index has seen some significant moves this morning already. Russia's Medvedev has been covered on the wires as saying the world needs more reserve currency, so that global role of the US dollar is still very much in question. In turn as well, we've seen continued uptrend for the sterling pound against the dollar this morning, cable hitting a 7-month high, euro dollar also striking a 5-month high this morning. And that just takes us through then to the other equity news of note at the moment. Obviously, as I mentioned, equities slightly lower, in particular Vodafone, they're the biggest decliner in the FTSE index, which is underperforming its European peers, the FTSE index at the moment. Again, led lower by Vodafone, who are ex-dividend today. And in terms of the big three car makers, that news somewhat being ignored so far this morning after their contractions for the US total May sales were pretty bad, but not as bad as some had feared. So for the data today, we're looking out now for the European services PMIs, the Italian number just about to come out shortly. We're looking out for any more improvements there to follow on from the PMI manufacturing we saw earlier in the week. Other than that, we'll be looking at Eurozone GDP at 10 o'clock. Then for the US data, eyes will be on the challenging job cuts and ADP employment change, obviously ahead of non-farm Friday. And then we'll also see the ISM non-manufacturing composite factory orders and all inventory levels later on in today's session.